Students, now let's have a look at another chapter. The chapter name is Capital Structure and Leverage. What is capital structure and leverage? Let's have a look the basic background before. A firm's total assets are financed by equity and debt. Liability side of company's balance sheet is composed of short-term, long-term and equity, and its composition is known as financial structures. So, company that uses the debt financing along with equity is called a levered company. So, equity and debt leverage. Finally, company always seeking issue around whether or not a firm should use debt financing or not. Optimal capital structures. What is optimal capital structures? There is two ways. One is traditional approach. The capital structure affects the value of a firm. That is the concept of traditional approach, and there exists an optimal capital structure. So there is always optimal capital structures between the debt and equity. But the modern approach says that capital structure is irrelevant to its value of the firm. So two firms alike in every steps except their capital structures must have the same value. The general rule of the thumb is that use of higher debt financing maximize the earning per share of shareholder because the cost of financing is relatively cheaper due to the tax advantage in the debt. The financial manager always seeks to maintain an optimal capital structure that maximizes the value of the firm and minimize the cost of capital. Now let's have a look the business risks and leverage. What is business risks? First of all, let's have a look what is risk. Risk is a variability in return, and return in investment or ROIs varies due to the various inherent factors. So the business risk is the variations in return due to inherent attributes of operations of firm. It is also known as operating risk. There is a formula. Formula is how to calculate the business risk, and ROIC is equal to NOPAT whole divided by capital, where ROIC is equal to return on invested capital, NOPAT is equal to net operating profit after tax, or you can calculate directly ROIC is equal to net income divided by common equity. So what are those inherent factors affecting business risk? First of all, variability in demand. So if there is variability or differentiation between the budgeted or expected demand and the actual demand, there will be definitely the variability in sales revenue. So demand variability is one of the number one reason that affects the business risk. Second, the variability in sales price. Also, sales price might also differ because of various reasons. So the projected sales price may not equal to the actual or forecasted sales price, and that brings the business risk. Another is uncertainty in input cost. The input cost, or the cost such as the fixed cost or the prime cost or any kind of cost that might vary, and that brings the differentiation in the actual cost, and that brings the business risk. Fourth, the availability of price adjustment. And fifth, the speed of technological change. This is the most important factor in recent modern world, that the change in technology or technological change is one of the biggest change for the business risk. Lastly, extent of the fixed operating cost. The fixed cost also varies, or it depends heavily upon the fixed cost while calculating the leverage. Now let's have a look the operating leverage. The term leverage is derived from the physics. It refers to the use of lever to raise a heavy object with a small object. So the operating leverage shows the responsiveness of the change in operating profit to the change in sales with the potential use of fixed costs. There is one formula that we can find out the degree of operating leverage is calculated by percentage change in EBIT divided by percentage change in sales or if we want DOL in unit, then the formula is contribution margin divided by earning before interest and tax. Or we can elaborate DOL at Q units is quantity sales minus sales price minus variable cost divided by quantity sales minus V minus fixed cost. Earning before interest tax plus fixed cost divided by EBIT so DOL at units can be find out as Q divided by Q minus BEP break even point units Just to clarify our concept, let's have a look the practical question here. I have got an income statement here. Sales unit in 10,000, 15,000 and 20,000. So we find out here degree of operating leverage DOL is equal to, we know the formula, that change in EBIT divided by change in sales. So let's have a look. If we look the column second and third, In 15,000, the earning before interest and tax is 25,000, and in 20,000 units, the EBIT is 50,000. Change in earning before interest and tax. Change is 50,000 minus 25,000 divided by 25,000. So 25,000 divided by 25,000, that gives 1. That is 100%. So change in sales, sales revenue for 10,000 is 150, and for 20,000 it's 200,000. So 200,000 minus 150 divided by 150, we get the value 50,000 divided by 150. So degree of operating leverage is change in earning before interest and tax is 100%, and change in sales is 33.33. That means let's divide 100 by 33.33. We get the value 3.03. Now let's have a look at the financial risk. So far we only assumed all the equity and stocks are unlevered, but firms uses both equity and capital to finance the firm. Firms with higher in debt and equity is known as highly levered firm. So what is financial leverage? Financial leverage explains how the given change in operating income of a firm affects its EPS or earning per share and earning to the common stock. Financial leverage exists because of the use of fixed charge bearing securities such as bond and preferred stock. Finally, it refers to the use of debt in business, that is debt to asset ratio. So let's have a look at the formula. Degree of financial leverage is equal to percentage change in net income or EPS divided by percentage change in EBIT. Let's have a look one example here. We have a income statement here, before and after of change in sales unit. So earning before interest and tax before is $15,000 and after it became 18,000 less interest. So interest here is 5,000 and 5,000 equally. Earning before tax is 10,000, 13,000, and tax is 50,000, and our earning per share or earning after tax is 50,000 for before and 6,500 for after tax. Required degree of financial leverage. We know that the degree of financial leverage we can find out percentage change in net income or earning per shares divided by change in earning before interest and tax. That means let's find out percentage change in net income. That is the 500. So change is the change we can find out $6,500 minus 5,000 is 1,500 divided by 5,000. We get divide by 5,000 0.3. Now 15,000, so new is 15,000, 18,000 minus 15,000 divided by 15,000. That means 3,000 divided by 15,000 is equal to 3 divided by 15 is 0.2. So DFL is equal to change in net income is 30% and change in earning before interest and tax is 20%. So 30 divided by 20 is 1.5 times. Now let's have a look the final type of leverage, which is total leverage. Total leverage is very simple to calculate. It is calculated by multiplying the operating leverage and financial leverage. Degree of total leverage is receives degree of operating leverage multiplied by degree of financial leverage, where DTL is equal to degree of total leverage, DOL is equal to degree of operating leverage, then DFL is equal to degree of financial leverage. So from the previous example, let's find out the degree of total leverage. We know that given from previous example, degree of operating leverage was 3 times and degree of financial leverage 1.5 times. So we can calculate degree of total leverage is equal to degree of operating leverage multiplied by degree of financial leverage. So simply 3 multiplied by 1.5, it is 4.5 times. Students, now let's have a look at another concept known as break-even point. What is break-even point? Break-even point is that specific point where the total sales equal to the total operating cost. This is the main concept behind break-even point. Yes, multiply by Q divided by fixed cost plus B multiplied by Q, where S is equal to selling price per unit, V is equal to variable cost, FC is equal to fixed cost, Q is equal to quantity to be produced and sold. So if we manipulate this formula, we can do such as S multiplied by Q minus V multiplied by Q is equal to FC. Taking Q common, S minus V is equal to FC. In this way, Q BEP, key in units, is equal to fixed cost divided by S minus V. This is in unit. Now let's have a look. BEP in cash. BEP in cash, we have to calculate fixed cost divided by contribution margin ratio. So we need to contribution margin ratio here. Contribution margin ratio is calculated by total contribution margin divided by sales. So S minus P divided by sales. Break even point charts. X-axis is units to be sold and produced in thousand. Then y-axis is revenue and cost in thousand. So let's remind the fundamental of cost and revenue figure in economics or in account class. So horizontal line is the fixed cost, we know that. Then the variable cost, this is total variable cost, which is fixed cost plus variable cost is total variable cost, or in this case this is total operating cost. Then we know that the sales revenue which is total sales cost. The break-even point is total sales, which is this one. Total sales cost is equal to total operating cost. Total operating cost is this one. Total operating cost and total variable cost. So this point is the BEP point, where BEP point. Let's check one example here. For example, we are given the fixed cost is 50,000, variable cost per unit is $5, and selling price per unit is $10. So let's calculate BEP unit is equal to fixed cost divided by selling price minus variable cost. Fixed cost, we know that $50,000, and variable cost is selling price is $10, then variable cost is 5. So 50,000 divided by $5, so we get 10,000 units is our BEP in units. So simply let's put all of this value in the BEP charts. So the fixed cost is $50,000, BEP units is 10,000, total sales revenue is $10 multiplied by total quantity, and total variable cost is $5 multiplied by quantity sold. This point here is 10,000 because this is the BEP point. Now let's have a look the cash break-even point. What is cash break-even point? So far we have calculated the break-even point based on the fixed cost that also includes all costs. Cash BEP we calculate, we minus fixed cost, non-cash fixed cost, and the same thing divide by selling price minus variable cost. For example, the non-cash cost, non-cash fixed cost is depreciation. Depreciation is not cash, so its value is $10,000. Let's calculate the cash BEP. We know that fixed cost is $50,000, then 10,000 is non-fixed cash, which is depreciation. Selling price per unit is $10,000, $10, and variable cost is $5. In this way, 40,000 divided by 5. So the new BEP 8,000 unit. Or if we want cash BEP in dollar, fixed cost minus depreciation divided by CMR, where CMR we already calculated 0.5 times. Therefore fixed cost is $50,000, depreciation is 10,000, then 0.5 times, therefore $40,000 divided by 0.5 times, we get $80,000. The cash fixed cost is only 40,000 because 10,000 is depreciation, so we have to calculate cash fixed cost is 40,000 only. Cash fixed cost. Cash break-even point, we know that the cash break-even point is 8,000 unit. So this is 10,000. So 8,000 would be around here. So let's determine. So this is cash total variable cost, and this is our cash BEP. Cash BEP, cash break-even point, this one, and the amount is 80,000. Students, now let's have a look the last break-even point style, which is financial break-point style. So far we have only calculated the break-even point based on operating cost. So now we need to calculate the break-even point that is based on finance cost. So what is financial BEP? Amount of earning before interest and tax at which firm's earning per share is 0. So BEP is calculated to determine level of earning before interest and tax at which firm can just cover all the finance cost, and those finance cost is both interest on debt capital and dividend paid to preferred stock. First of all, let's find out the condition here. Condition should be earning per share is equal to 0. So earning before interest and tax minus 1 multiplied by 1 minus tax minus DPS divided by NCS is equal to 0, where EB is equal to earning and tax, I is equal to interest expenses, DPS is equal to dividend per share, T is equal to corporate tax, then finally NCS is equal to number of outstanding share on common stock. EBIT minus 1 minus T, DPS is equal to 0. So EBIT financial BP is equal to I plus dividend per share DPS 1 minus T. So let's put all the value on this formula. We have I is the interest rate, which is $75,000, $75,000. The DPS is dividend on preferred stock, so the dividend preferred stock is 15,000. Tax rate is 40. Financial BP chart as follow. Like this, y-axis, x-axis, EPS in dollar, EBIT in dollar. Our earning per share curve is going upward like this, which is EPS. So this is our EPS, where EPS is equal to 0. The financial break-even point is $8.1,000. So financial BP in this way, earning before interest and tax is somewhere here, so our EPS should be EPS is 2.25 here, or 2.25 EPS.